Hi, welcome to my YouTube channel, My Solution. I'm Raul. In this video, you will learn about notes receivable. Notes receivable are claims arising from sale of merchandise or service in the ordinary course of business. These are claims supported by formal promises to pay, usually in the form of notes. In other words, it is a written contract in which one person, known as the maker, promises to pay another person, known as the payee, a definite sum of money. The note may be on demand or at a definite future date. There are cases where the notes issued was dishonored. So when do we say that notes was dishonored? When the maker of the notes fails to pay on due date, the notes receivable is considered to be dishonored. A dishonored note is no longer negotiable. Therefore, this shall be removed from the notes receivable account and transferred to accounts receivable that will represent only an ordinary claim against the maker or at an amount to include, if any, interest and other charges. Dishonored notes receivable should be recorded in creditor's book as follows. You debit to accounts receivable and credit to notes receivable plus the interest income if there is any. Measurement of notes receivable. Conceptually, notes receivable shall be measured initially at present value. Present value of the sum of all future cash flows discounted using the prevailing market rate of interest for similar notes. However, short-term notes receivable are measured at face value. Cash flows relating to short-term notes receivable are not discounted anymore because the effect of discounting is usually not material. For long-term notes, initial measurement will depend on whether the notes are interest-bearing or non-interest-bearing. Interest-bearing long-term notes are measured at face value, which is actually the present value upon issuance, while non-interest-bearing long-term notes receivable are measured at present value, which is the discounted value of the future cash flows using the effective interest rate. Subsequent to initial recognition, long-term notes receivable shall be measured at amortized cost using the effective interest method. The amortized cost is the present value plus the amortization of the discount or the face value minus the unamortized unearned interest income. Let me give you some illustration problem on long-term notes receivable. On January 1, 2020, an entity sold an equipment costing $300,000 with an accumulated depreciation of $125,000. The entity received as consideration $50,000 cash and a $200,000 non-interest-bearing note due on January 1, 2023. The prevailing rate of interest for a note of this type is 10%. The present value of one at 10% for 3 years is 0.713. Required: prepare all the pertinent and journal entries in this transaction. Observe that the note is collectible on a lump sum basis after 3 years. As we discussed earlier, long-term non-interest-bearing notes receivable initially measured at present value. Therefore, our first step is to calculate the present value of the notes. As you can see in the problem, the prevailing rate of interest for this type of note is 10%. Present value factor was already given as 0.7513. There are cases wherein this factor is not available, so you have to use present value table. To calculate the present value, we just have to multiply 200,000, which is the face of the note, to the present value factor or 0.713, and you will get 150,260 to arrive with the present value. Next is we deduct the face of note to the present value we just calculated to get the unearned interest income. The unearned interest income is sometimes described as discount on note receivable. Next, after calculating the unearned interest income, we need to compute for the sales price or how much we sold the equipment. Selling price would include the present value of the note and the cash payment. So just add 150,260 and cash received of 50,000, totaling to 200,260. After computing the selling price, we have to compute as well the gain or loss on sale of equipment. To arrive for the gain on sale, simply deduct the selling price of 200,260 to its carrying value. Carrying value is equal to cost of the equipment amounting to 300,000 minus the accumulated depreciation of 125,000 equals 175. So selling price of 200,260 minus the carrying value of 175 equals 25,260. Observe the selling price is more than the carrying value. That means the difference is gain on sale of equipment. Now we are ready to record the necessary entry on the date of sale. So the pertinent entry should be a debit to cash of 50,000, a debit to notes receivable 200,000. We have to close also the accumulated depreciation of the equipment, which is 125,000, and we credit equipment 300,000. We debit the gain on sale of equipment 25,260 and credit unearned interest income 49,740. Then coming December 31, 2020, the entity should recognize interest income. But first, let's prepare the table to easily record all pertinent entries. I will prepare the table by myself and will try to explain to you later on how it was arrived to save time. So now, by looking on the table on December 31, 2020, to record the interest income, you have to debit unearned interest income of 15,026 and credit to interest income of 15,026. Observe the amortization table. The effective interest method is used. The interest income is computed by multiplying the present value to the effective interest rate, which is 10%. So for 2020, 150,260 multiplied by 10%, you will get 15,026. The unearned interest income is arrived by deducting the interest income from the unearned interest income previous balance. Therefore, on December 31, 2020, 49,740 minus 15,026 is equal to 34,714. The present value is arrived by adding the interest income to the preceding present value balance. Thus, on December 31, 2020, 150,260 plus 15,026 is equals to 165,286. Or face value of note minus unearned interest income equals present value. Therefore, on December 31, 2020, 200,000 minus 34,714 is equal to 165,286. In 2021 and 2022, we have to recognize the interest income by recording the following entries. December 31, 2021, debit unearned interest income 16,528.50, and you have to credit interest income amounting to 16,528.50. In December 31, 2022, you have to debit unearned interest income for 18,185.50 and credit interest income 18,185.50. Then on due date 2023, we have to record the collection of note by debiting cash 200,000 and crediting notes receivable 200,000. However, in case the maker of the note failed to pay his obligation, then we have to record the following entry. You have to debit to accounts receivable 200,000 and credit to notes receivable 200,000. This concept was already discussed earlier. And that's all for notes receivable. Thank you for watching and I hope you liked the video. Please don't forget to subscribe and give your comment. Bye bye.